Hi everybody, my name is JJ. You're watching Bull, Boom, Bear, Bust. It is Saturday, March 7th. So welcome back to the channel. We just want to recap the insane week we had here in the markets, in the economy, in the world when you look at it. And it's not just been an insane week, it's been an insane month, it's been an insane year, it's been an insane decade. We're going to just take a quick look back at the things that have unfolded here as far as economics and the manipulation that we've witnessed over the past decade, but especially just here in the past month and this past week as things have unfolded. Today we're going to talk about the Dow Jones prediction by me. Was I wrong? Was I not wrong? Well, yes and no. We'll talk about that. We're going to talk about the panic that's pretty much taken over the world. It's all over the media right now. Is it overhyped? Is it underhyped? Well, no matter which way you look at it, it's very polarizing, so we're going to talk about that. Also, airlines and cruise ship stocks are being basically decimated. Stocks down as much as 40%. We're going to talk about what that means. Is it a buying opportunity, or should we stay away? Come back again another day. We'll talk about that. Now, first of all, let's talk about kind of the big picture here. Let's go back to 2008 and let's see what happened to interest rates. There's a lot of news out lately, a lot of media covering the dropping of the interest rates. We had the emergency rate cut, half a percentage point cut, which is the first time that's happened since the financial crisis. And there's also talks of more rate cuts, which would put us on the pace to being at negative rates before the end of the year if they do these types of cuts, these half a percent rate cuts, at each subsequent Fed meeting. We'll see how that plays out, but we are on pace to hit negative rates if they continue at this pace of cutting. But look back to 2008, the Fed had essentially 0% interest rates for nearly 8 years after the financial crisis. So a picture tells 1,000 words. I like to show this chart, pretty frequently, and just ask yourself, would we need nearly 0% interest rates if we really had a strong economy? Right? Savers get punished by this. It's been over a decade now since you've been really able to get any sort of return on your money if you put it into a savings account or a CD or an interest-bearing money market or something like that. And just that by itself devalues the worth of actually trying to save money and put it away for a rainy day, so to speak. And a lot of people choose to not save and just go ahead and just spend as they earn it, and therefore you've got a huge portion of the population now that lives paycheck to paycheck, by some voluntarily choosing to do that because really savings gets you hardly anything in return. And even if you do save money, hoping to build up a nest egg, by the time you go to spend it, prices have doubled and maybe even tripled depending on what you're talking about. If you're talking about housing, it's more than doubled in some areas in that time frame in the past 10 years. So it incentivizes people not to save. Of course, the corporations, they love it because people are spending money, and most of the time when you go out and spend money, especially on entertainment, you're giving it to very people that are already very wealthy. When you spend money on Amazon, when you buy a car, all of those things, you're basically handing the money to somebody that's very wealthy when you look at the CEOs and the corporate structures. Now, going into year 2016, the Fed started to raise rates, but it was very mild compared to the previous rate hikes. Look at the one before the financial crisis, how drastic of a rate increase that was. We went from about 1% up to about 5% in just a matter of about a year. That was a pretty big, rapid increase of about 4%. The Fed did not attempt that this time, I think, for many reasons. A lot of eyes are on the Fed, especially now with the current administration putting out all the tweets about the Fed and criticism of the Fed. And just the fact that we have social media here and ways to communicate, such as the program you're looking at today, has really woken a lot more people up to the Fed and how the economy can be manipulated. Back then, sure, the internet was out there, but not very many people knew about even the general functions of how the economy works and interest rates, central banking, and all of those things that have kind of come out of the shadows here in the past 5 or 10 years or so, and are now under a bigger spotlight, so to speak. Quick look at all the topics here. Let's talk about my call for Dow Jones 30,000. Now, we did get very close. We got within just a few hundred points of the Dow Jones being at 30,000. if you've been on this program for a year or more, you know I've been calling for the stock market to be manipulated, and the Dow Jones is the most well publicized, so we talk about that. And I had predicted 30,000 at least, and then 32,000 before the end of the year with the manipulation. With the current administration out there trying to make the economy look good by pointing to the stock market, even though it should not be like that. The stock market should not be a gauge of the economy. It should be the middle class and savings and wages that should be really the sign of a strong economy, but we know those things do not look so good for most people. Of course, you do have the top 10% that are doing pretty good, but then bottom 90% not so good. In fact, the bottom 90%, most people live paycheck to paycheck. Again, like we talked about earlier, some by choice, others by necessity, right? Savings get you hardly anything. A lot of people just choose to go ahead and spend it or invest it in something that's going to give you more than a 1% or a fraction of a percent return. All right, next, my call for Dow Jones 30,000. Was I wrong? Well, not really. Let's talk about it. Let's go back here to February 12th. This is where we saw the high on the Dow Jones, and we reached an intraday high of 29,568. So if you want to what's it called, split hairs, I was didn't quite hit that number. But remember, as I've been saying here for the last year or two, there's always a possibility of a black swan event. And what happened? The definition of a black swan event happened. We had this insanity fly out of the world's second largest economy. We've got panic still spread across the globe, including escalating panic here in the US. So I always say, do not listen to me, because this is just my opinion. Everything I say in this channel, anytime I make a prediction or give my opinion, I always say anything can happen. Black swan events, and that's what happened, black swan event. But even with the black swan event, still we almost hit that 30,000. We were less than 500 points away from it. So if you want to split hairs, yeah, I didn't get that, but the year's not done. I said before the end of 2020, we're only in early March, there's a good chance they could bring this back up. And you might want to ask yourself, if you think this is the beginning of the stock market crash, well, they could have let it crash even worse right now. I think the manipulation has actually kept it prop up with the plunge protection team. We have the Fed trading desk. Right, of course, those are non-transparent operations, so I can't tell you exactly how much or exactly what they're buying, but I do know those areas exist for a reason. Ask yourself, if they weren't going to use those tools, why would they have a plunge protection team? Why would they have a Fed trading desk? And I think the manipulation goes much further than what most people realize. And again, it's not transparent. So it's pretty much guesswork as far as anyone trying to figure out exactly what's happening behind the scenes. But we can look at the fluctuations and pretty much figure out that this is being manipulated. For example, let's just take a look at the last day of trading, which was Friday, March 6th. We saw this huge drop at open. It was down overnight, and then slight recovery intraday, another big drop, and then a miraculous recovery at the end of the day. Of course, we did have some pretty good job numbers that came out, but keep in mind those job numbers are looking back, and they do not take into account all of the recent companies that have sent people home, the restaurants that are closing, the industries that are being devastated, especially the airline and travel industries and cruise ships. And we're going to talk about that next, but the level of manipulation is pretty obvious here. Now let's take a look at something a little more recent here. This is the repo just from the last trading day, which was yesterday, Friday, March 6th. And what do we see? We saw another, if I can get my screen here, over 87 billion in repo bailouts to these banks. Now think about what would happen to the overnight interest rate, the intrabank lending rate, banks borrowing on short term. If those interest rates were to stay elevated, a lot of very bad things could evolve from that. You could see bank failures, and of course now we have the banks out there pushing for more deregulation. They want lower liquidity requirements, that way they can go ahead and lend out more money they don't have without having to worry about skating too close to that reserve requirement. And keep in mind, in the fractional reserve system, banks are already lending out many times more money than they actually have in reserves. And who knows, before it's done, maybe banks do not even need to have any money in reserves. They can just go ahead and issue debt and therefore create currency at the time of putting out a loan or giving out a loan, and there'll be no limits. They don't need to have any reserves. Right, it sounds insane, but really we're not too far from that right now, considering the very minimal amount of money that banks have to have in their deposits to be able to lend out money. Right, we're talking leverage 10 times and beyond what these banks have in reserves. Now back to my Dow Jones prediction of at least 30,000 before the end of 2020. When you look at it year over year, we're still up from last year, which is pretty amazing when you consider the panic that's spread across the globe right now. And this panic that we're seeing spreading and expanding, causing people to wait in line at Costco, sometimes for an hour, 2 hours, 3 hours, causing people to wear masks and stay home, and trying to avoid crowds and of course not travel. And therefore we see the cruise ships and the travel industry being hit very hard. Considering all the panic that's been unleashed, looking at the Dow Jones, it could be much worse. We're still up compared to a year ago. And ask yourself, now is the perfect time to completely let the market crash or collapse. And there's a couple different ways to look at it. One way is this is the perfect opportunity. So if they were going to completely collapse the stock market, then they would have done it, because this takes the eyes off them. It takes the blames off the bankers and their policies and the politicians, and it gives them the perfect excuse. So with the perfect excuse out there, why not just go ahead and let it collapse? And maybe that's their plan. A lot of people think what's happened here since we saw the bottom a couple weeks ago, they're calling this a dead cat bounce. Right, that's where we get a big sell-off and then we get a recovery. It suckers people back into the market thinking it's going to be a recovery. And then boom, another big drop, a big sell-off. And all those people that thought it was a bounce that was going to go back to new highs are left holding the bag, so to speak. So it could be a dead cat bounce. I still hold the prediction that we're going to see Dow Jones 30K minimum. But then again, we have this super polarizing event that's spread across the globe again. A lot of people, and I say polarizing because a lot of people have such wide varying opinions on this. If you ask certain people, they look at it as a global pandemic that's going to eliminate most of the world's population. If you ask other people, they say it's overhyped, it's a media concoction meant to spread fear and panic. And there was even one person that said in comments that this was a ploy by the toilet paper industry to bump up sales, and we saw the people waiting in line at Costco for toilet paper. I think that was more of a joke. I hope it was. But I wouldn't put anything past anyone at this point. Who knows? When it comes to the toilet paper, it's interesting though. You can get toilet paper at a lot of places. Costco, yes, they're cheap. They're a little bit cheaper, but you want to wait in line for 1 or 2 hours to save $1.50 on a bundle of toilet paper? Right? Come on, people. Go to Big Lots. Go to Walmart. Especially if you think your diarrhea is going to be that bad. If you have to self-quarantine at your home. Now, speaking of a buy the dip opportunity, which I will not be doing, but I'm still calling for a new rise, new highs in the stock market. Barron's is out there saying, look how cheap these airline stocks are, and it gives us a chart here of the sell-off, and the demand has dropped off so drastically. We see some airlines dropping more than 40%. If we look down here, we see the blue line and the black line. Those represent United Airlines and American Airlines, the hardest hit airlines there. Will you be buying the dip? Let me know. Is this whole scare overblown? Or is the pandemic going to continue to spread and we're going to turn into ghost cities here because it's going to be so devastating? If that's the case, it's been nice chatting with you on this channel. If I don't come back, you know it got me. Either way, hope you're safe, hope you're prepared. Ride the bull, prepare for the bear as always. Thank you very much for watching. Hope you have a great one. Bye for now.